Wanted to talk to you very quickly. My son-in-law came over the weekend and he had bought literally about an hour and a half before a brand new automobile. Now, I will preface this by saying, well, it wasn't exactly brand new. It was a used automobile. Very nice automobile, was kept in supreme condition. Everything went well, and all of the financing seemed to go really well. However, when I began to question him, I had asked probably one of the most important questions in the world, and that was, what is the interest rate? My son-in-law wound up paying 8% as an interest rate. Now, understand something. Here we are in January 2023. Slowly but surely, inflation is starting to recede, but we're also starting to see very slow GDP growth. And when we look at slowing GDP growth, according to economists' definitions, when we get to 2 slow quarters, we start to see signs of a recession. We're also starting to see the repealment of merger and acquisition activity. We're also starting to see that housing is beginning to slow down. While the Fed is increasing rates, and there is some condition that the Fed may actually wind up increasing the rates one more time by perhaps what I believe a quarter of a point, the fact is that interest rates are beginning to rise, and several things are happening that you need to understand. Number one, the cost of borrowing amongst banks is still relatively inexpensive. Roughly 3 to 4%. 10, 30-year Treasury bonds are still trading at very, very low numbers. Numbers not seen in decades. But understand something. The value of automobiles has come down. And similar to the way that you price bonds and the interest on those bonds, there's an inverse relationship. And given the fact that there's an inverse relationship with the value of automobiles, the interest rates are now going up. I believe, simply because of the fact that these interest rates are going to be quite high, that one or two things is going to occur in the next several months to perhaps even the next year. Number one, even if interest rates are going to remain where they are, let's say the Fed does stop increasing the rates and they stay at where they are today, 8% is still relatively high from where it was 2, 3, if not 4 years ago. And let's face it, if we are hit with a recession, if we are hit with unemployment, if in fact companies are doing what they're continually starting to do right now, and that is lay people off, there will be less spending here in the United States. When there is less spending because of income, what will happen is people will start to play Russian roulette or poker with what they consider of what bill is of importance. In other words, what's going to be priority? Do I pay my grocery bill? Do I pay my electric bill? Do I pay my automobile bill? Will I pay my mortgage? And what we're going to start seeing is increased borrowing, as we are right now, and perhaps the delay of the repayment of debt. We're starting to see a lot of lagging debt repayment just in the commercial sector. Look at some of the companies that are having unbelievable issues right now, from Salesforce to Bed Bath & Beyond and many others. It's going to hit in the consumer marketplace. And more importantly, when that starts to happen, we're going to continue to see market volatility. So from that particular perspective, what are some ways to protect your money? What are some ways to protect you? And what are some things to think about in the next 1.5 to 2 years? First and foremost, if you don't have to borrow, then don't. The easiest cost of borrowing is when you have cash and not going into debt and not paying high debt fees. Number two, you have to remember that when you are going to pay in debt, even if you start to pay in debt and you're delayed by a half a day or a full day, you need to look at the proper paperwork, because that 8% can quickly become a 26% interest rate. You really want to think about what the ramifications to you and your pocketbook are going to be. So therefore, paying in cash is probably going to be a good thing to do. Number two, if you do have high debt today, probably a good thing to consider is debt consolidation. Look for the lowest interest rate that you have, put it on one credit card, and get rid of that debt as quickly as possible. Three, only use cash. We live in America. America is a land of capitalism. We love to buy, and we love to buy material things. But the fact is that as inflation is starting to come down, and if the fear is a recession, or if recession hits, and it is possible, then from that particular perspective, do you want to get caught on the blind side? And the answer to that is no. So the easiest thing that you can do is then to hold off where you can, so that you can wait until a better tomorrow when you really and truly need that material item. And one other last thing I want to suggest to you, and that is simply this. Mortgage rates have been bouncing around for quite some time, and the housing industry is beginning to slow down. We're seeing houses sitting on the market a little bit longer than they were before, which means much more negotiation power at this particular point in time. Yes, it does mean more scrutiny when it comes to mortgage rates, but the fact is when we're looking at housing and mortgages, the fact is that you have a little bit more power than you did before. And the reason why I bring this up is, especially in cities like my own, they're building apartment complexes like there's no tomorrow. They're handing them out like cookies, and apartment fees have gone up substantially. Well, there's a big difference in paying an $1,800 a month apartment fee versus paying a $1,400 or $1,500 a month mortgage. You'd have to check in with your tax advisor or CPA to determine your tax advantages. But the fact is that if you're going to get a tax advantage by buying something, a condo, a townhome, or a single family structure versus paying for an apartment, you might be in a better condition. So just a few things to think about as we start to level out on this inflation, as we begin to see higher interest rates, and more importantly, as you start to consider your financial future. This is Drew Stevens. I look forward to seeing you at some of the webinars that I have hosted here on myCPE.